Your home needs a little TLC, but you're having trouble scraping together the cash to cover all of the repairs. That's where credit might help. When buying on credit, you borrow money from creditors, a bank or another type of lender. In exchange, you make regular payments for an extended period of time, until you've paid off the total price of goods or services bought. Depending on the type of credit you secure, you also may need to pay interest, a percentage of the total amount you borrow. There are three main types of credit: installment, revolving, and open. Home improvement loans, mortgages, student loans, and car loans are examples of installment credit. A creditor approves the loan for a specific purchase for a fixed number of payments at a set dollar amount each month. You'll make the exact same payment amount on the same due date each week or each month, depending on the lender's terms. Installment credit allows you to plan exactly how much you'll spend and for how long you'll be obligated to make the payments. Revolving credit does not have a fixed number of payments, and what you pay can vary greatly depending on how much you spend monthly. A credit card is an example of revolving credit. It has a limit to how much you can borrow and a specific due date each month. Purchases can be charged at any time, but the card balance increases rapidly if it isn't reduced to zero every month. Here's a situation to avoid. Let's say you needed to make a few home repairs. Because you were short on cash, you used a credit card to purchase some power tools. Rather than paying off that balance right away, you paid only the minimum payment required each month. Unfortunately, with the interest building over several months, you ended up paying nearly twice as much for those tools. More cost-effective options would have been to make larger payments more frequently to get the balance down, or you might have been able to secure a home improvement installment loan with a fixed rate instead. The third type of credit, often called open credit, includes utility bills or cell phone bills. While you won't be charged interest if you don't pay by the due date each month, you'll probably face late fees or other penalties that can be rather expensive. What are some benefits to borrowing? Credit helps people purchase things they couldn't afford to pay in full up front. A mortgage can facilitate acquiring a new home. A student loan can help obtain a certification or a college degree. A credit card may be a lifesaver if you need to pay for an extended hospital stay. Building a credit history is yet another benefit to borrowing through loans, mortgages, and credit cards. Your credit history is a record of the debts you've acquired and how responsibly you've paid them. Credit agencies use this history to calculate a credit score, a number between 300 and 850. Your score tells lenders how likely you are to repay loans. If you pay off credit regularly and on time, your credit score will become higher and more favorable. If you pay late or infrequently, or if you default on loans, your score will plummet. The result? Lenders will see you as high risk. They won't give you lower interest rates and may refuse to approve a credit application. Carefully choosing what you truly need to buy, along with paying on time and repaying in full, are the most important tips for using credit responsibly. Also, always review communications and credit statements from lenders and report any issues to them. In short, credit is an important tool for both buyers and sellers that helps us exchange goods and services in our economy.